Well, welcome back to another episode of Finance Uncut. On today's episode, we're going to discuss, is the stock market about to crash? Well, the Dow Jones isn't crashing at the moment. In fact, it's hit an all-time high. It's now hit 30,000 points, the Dow. This is really crazy to think that the stock market has hit an all-time high when we're in the middle of a pandemic, in the middle of a global recession. People need to think about that. So why is the stock market so high? Well, let me tell you one thing. It's got nothing to do with the economy, got nothing to do with fundamentals. It is all about liquidity. I've got another graph I don't have in this video, which just shows that liquidity over the last decade, or really since the GFC, has been leading asset prices. So as liquidity goes up, asset prices go up. When liquidity comes down, asset prices come down. And so it's really been a liquidity game. There is no correlation, no connection between asset prices and the real economy. So fundamentals have gone out the window, but it cannot last forever. So in this video, we're going to discuss the stock market crash. And we're going to discuss it in two different ways. A stock market crash in nominal terms, or a stock market crash in real inflation adjusted terms. So Peter Schiff is one guy who thinks we are going to see a stock market crash of maybe 70 or 80%, but not in nominal terms, not in dollar terms, but in real inflation adjusted terms. So measuring the stock market against gold, that because of the monetary inflation that is being created, that moving into 2021 and 2022 and throughout this decade, is that we're going to see a huge devaluation of the dollar, of currencies, and we're going to see things like gold, maybe some cryptocurrencies, silver, severely outperform other asset classes. So Peter's saying that ultimately he doesn't think in nominal terms that the stock market will go down. He thinks that we are now in a position where central banks cannot wind back the stimulus, the quantitative easing. They cannot lift interest rates. And we only need to look back a couple of years in 2018 when the Fed were trying to continue to lift interest rates, and they basically tanked the market, and they had to stop and change course. And this is where I think we are right around the world, is central banks have backed themselves into a corner with low interest rates, encouraging people to borrow. We're seeing the debt levels out of control, and we'll have a look at that in this video. And people are taking on a lot more risk. So risk is on at the moment. People are piling into risk assets to generate something. So we've got huge government intervention, central bank intervention. And now that the debt levels are so high that not even households and businesses can cope with any decent interest rate rise, but governments. So governments are really now insolvent. So many governments are now insolvent that they couldn't even pay back the debts if interest rates were to rise. So Peter Schiff thinks that central banks, governments have now backed themselves into a corner where we will have interest rates at all-time lows, even going even lower into negative interest rate territory. And even if inflation, CPI price increases continue and go well above 2%, 3%, 4%, 5%, so on, that central banks won't be able to raise interest rates. Because if they did, then they would bring down the economy. There would be mass defaults, mass bankruptcies, and asset prices would collapse. And there's this whole inflation, deflation debate happening at the moment. And I think in a free market, yes, we would have deflation. We would have deflation right now in this global recession. But for central banks and governments that have just pumping liquidity into the market, yeah, we might not be having the huge CPI price increases, although we'll have a look at that in this video as well. What it has done is prevented assets from deflating. We had a deflationary period of about 3 weeks back in March, and then since then it's been asset price increase. But the Fed has issued warnings about high debt and overvalued asset prices, yet it can do nothing about it. It cannot address it. We are now stuck in this vortex of doom, if you'd like, with low interest rates, continuous stimulus. Otherwise, the house of cards falls down. And that's where we do get a crash in nominal terms. But what Peter Schiff is arguing is that we're going to get a crash in real terms. So we look at the S&P 500 versus corporate profits after tax. And once again, we can see the S&P in blue. You can see during the dot-com bubble that the S&P became overvalued. It broke away from the real economy, earnings, corporate profits after taxes, and it had to basically come back to the real economy, to fundamentals. But look at it now, or really since about 2016, which is once again when I started to sell my positions in the US market. Right through to 2018. By 2018, I was completely out of the market. So yes, I've missed out on a lot of the gains in the US market, but I transferred that into precious metals, so I've done extremely well. So even though gold and silver has been taking a little bit of a tumble of recently, and we'll touch on that in this video as well, but right now you can see the largest disconnect between the S&P 500, and this goes around the world in any stock market, and the fundamentals. And so what we either need to see next year and the year after and so forth is either the greatest boom in history, so that corporate earnings and profits match where the S&P 500 or where the stock markets are, or the stock markets have to fall. So that would be a nominal, what I'm talking in nominal terms. But these are the two debates. See, we've got the deflationists out there saying that asset prices are going to fall in nominal terms, and then we've got the inflationists that say no, it will crash, but it's going to crash in real terms. When we look at US equity valuations, price to sales, they're now all-time highs. They're now surpassing those levels of the dot-com bubble. US tech stocks earning yield, once again, it's just on this basis, we're now looking at that tech bubble. So once again, folks, if you're looking at buying into the market now, into these tech stocks in particular, or buying indexes and ETFs, you're buying at these all-time high prices. Now, in the short term, yeah, it can go higher, but long term, will it? Will it? I think either way, it's going to crash, either in nominal terms or in real terms. Either in nominal terms or in real terms. When? Well, we don't know. No one has has the ability to see that. But if you continue to buy assets at these kind of prices, then moving forward, your earnings, your expected return over the next decade is going to be extremely low. Extremely low. When we look at growth versus value and emerging markets, you can see that growth has won out, and it's been winning out for some time. From about 2018 onwards, when we crashed back in March, you can see that growth has outperformed. It's just gone ballistic. Now, value has improved since March, but it hasn't got back to its previous highs. And this is where I think, as an investor, if you're going to go into the stock market, you really need to be picking individual stocks. You need to be analyzing individual companies and businesses and being very specific in where you allocate your capital. I think it's highly dangerous allocating capital into ETFs and index funds or just the tech stocks at such high multiples. I think you are taking on a lot of risk by doing that. Yet, as I've said in previous videos, I've invested in stocks during this last little period, even though valuations have been extremely high. I've been buying commodity stocks, gold stocks, gold explorers, also cobalt, nickel, copper, and actually coal. In fact, my coal positions just in the last month or so are up 50%. But I bought those at really cheap multiples. One company I bought, it was 2 times earnings. Another company was about 4 times earnings. You can't even buy private businesses at those type of multiples. So analyzing and finding undervalued, underloved stocks where over the long term, you've got a lot better chance of gaining higher returns, either through dividends, through capital appreciation of the stock, when you're buying at multiples like that. As I said, once again, it really is a liquidity driven market at the moment. And, just looking at the S&P 500 and the Fed's balance sheet, when the Fed increases its balance sheet and, buys assets in exchange for bank reserves, that's adding liquidity into the market, which the first thing, the Cantillon effect, is where that newly created currency goes to first, and it goes to assets first. It's this trickle down Keynesian pump up asset price. People feel rich, and so then they'll borrow and consume, and that's our economic model at the moment. What we need to do though is get back to more productive credit creation. If we're going to have this credit system, then we need to have productive credit creation where credit is created for productive investments in businesses, technologies and products and so forth, which actually produces wealth. So it actually produces growth, but without inflation, because it's creating more products and services. All right. And technology is deflationary. And so everyone's standard of living rises, because if everything's getting cheaper, but the economy is growing, you're getting wage rises, businesses are making more profit, but things are becoming cheaper. Well, guess what? You're getting wealthier. It's really basic. But instead, we have this consumptive and asset credit creation, where really the first thing is the asset credit creation, which is going into bonds, stocks, real estate, and so forth, which creates asset inflation, the boom bust cycle, which creates obviously crisis, and that's where everyone goes, "Oh, government help me, central banks help me, save us, save our assets." And so we've got this speculative asset credit creation thing going on, which then leads into that consumption. That consumptive credit creation, where we've got all this equity or there's this assets, wealth. So, what, we feel wealthier, so we're going to go buy a new car. We're going to go buy all the new furniture. We're going to go out to restaurants all the time because, we feel wealthier. And that's really, but it's not. The result with that then is you have this inflation, but without growth, without sustainable growth anyway. You just create this boom bust cycle. and governments no longer allow that bust cycle, so they just with the central banks just keep pumping this thing along. But because of this system that we've got, and if you want to go to WTF happened in 1971.com, I think is the address. I'll put a link in the description below. You can have a look at where the wealth inequality, income inequality, all these things really started was when our monetary system became this fiat debt-based system. When money stopped being gold, sound money, and became this fiat debt-based system. And it speaks for itself. But as central banks and governments continue to intervene into the market, it pushes assets up. Now, assets are generally held by people in the more wealthier brackets. And so you continue to get this wealth inequality happening. And you can see here 88% of corporate equities and mutual funds are held by the top 1%. So the top 1% own 88% of all the wealth in equities and mutual funds. Here, once again, you can see the bottom 50% compared to the top 1%. Share of corporate equities and mutual funds held by the bottom 50% has been going down and down and down and down. Have a look at that through the 90s. It was already low, but it's just been going down and down and down and down as central banks have intervened into the market to lower interest rates, to create this speculation, create this massive borrowing and debt, which feeds into asset prices. Labour force participation in blue, and CPI increases. So pretty much late 90s, the labour force participation has been heading down while CPI continues to go up. Now that is the pain of real poverty. That is the worst thing you can have, is when you have labour force participation or wage growth stagnation or even falling while your currency is being devalued, so the cost of living is going up. That is the worst, and that is what central banks and governments are trying to do right now. They are trying to create to devalue the currency, to try to inflate the debt away. Here, once again, don't say that people are out there saying banks aren't lending. Yes, they are. Banks are lending. They're just lending to the US government, and they're actually lending to the US government in a very aggressive way. In fact, this is record levels of banks lending to the government by buying US Treasuries. Some people call it wartime finance. Some people call it the US economy with Chinese characteristics. Just be careful that this is going to lead to the devaluation of currencies. So, banks, they're not lending as much to businesses and households. The C&I, there is commercial and industrial loans. So to businesses and households and whatnot, they're lending to governments. And as I said, this is going to lead to a devaluation of the currency. Some say that, as the central banks then buy those assets from the banking system, from the commercial banks, that it is like a quasi type of MMT. US Treasury securities being held by foreigners is going down, and it's been going down for some time. Yes, there was that low in 2016-17, but really it's been going down for some time. So then who is buying all this government debt, all these US Treasuries? If foreigners are reducing their holdings, then who's buying it? Well, that's the Fed themselves. That's the Fed themselves. So they are monetizing the debt basically using the commercial banks. But basically, ultimately, they are monetizing the debt. So they're the ones that are jumping in a very large way. Now, yes, foreigners are still buying and others are still buying, but ultimately the largest buyer of US Treasuries is the US Federal Reserve. And looking at the CPI, consumer price increases, what's interesting is the things that have really gone up in price are the things that we need, the things that we use on a day-to-day basis. Hospitals, so healthcare, education, childcare, medical care, all those sort of things. And even food has since, so this is obviously an old chart going to 2018. This year, food has been going up quite a lot. So all the things, in fact, a lot, I'm talking, 4 or 5%. If you believe the government's own numbers, where it's been other things like technology and things like that that have become more affordable. I don't know if you remember buying a plasma TV back in the day. I remember when they were like $10,000. Now you can get them for a few $100s. So there has been things that have seen deflation, but it's been in things like technology and the stuff. But the things that we buy on a day-to-day basis, things that we need that we can't go without, these things are getting more expensive, which is obviously devaluing our currency because we need more of that currency to buy the same stuff next year that we did this year, and so forth. I've mentioned ShadowStats before. You can see the web address there. I recommend going to it. Look, I'll put a link in the description below. But John Williams tracks the inflation numbers based on how they used to track. So this chart here is based on how they used to track it in 1980. Now you can read how he tracks that and how they used to track it in the 1980 and how they've changed it. This is the government, how they've changed it. And if you look at the 1980 numbers, our CPIU numbers are actually more like 7-8%. So imagine that. So here's the thing, we're not measuring apples with apples at the moment. So when you see the government CPI numbers, and then you go, oh, well, hang on, that's not as high as what it was in the 70s or the 80s or anything like that. Well, you can't do that because they measure them very differently. So you're measuring apples with oranges. What you need to do is measure apples with apples. So when you, and John Williams does this, he takes how they measured inflation or CPI in the 1980s and uses the same metrics today. And so based on those metrics, inflation's around 7, or CPI is around 7 to 8%, based on 1980s. 1990, so once again, they adjusted these. Then we're looking at CPI around 5%. So yeah, through the 70s, 80s, 90s to now, governments have continued to change the way they measure CPI. And so I like to look at John Williams' numbers because they really do show what the true, or at least comparing to the 1970s and 80s, when people always go, oh, we don't have inflation like we did in the 70s. Really? Don't we? This is what CPI looks like in terms of purchasing power of the dollar. So over the last 100 odd years, you can see that the purchasing power of the dollar has gone down somewhat, 97%. Incredible. Now, when you hear central banks say, well, hey, we want 2% inflation or 2 to 3% inflation is good, yeah, that's good. Danielle DiMartino Booth, who was an economist an advisor at the Fed, the Dallas branch Fed. She's been preaching pretty loudly this year that the inflation target should be zero. There should not be any inflation. The inflation rate should be zero, because inflation in itself devalues people's savings, workers. It steals their wages, and it steals their wealth. And so when we look at 2% inflation, this is what 2% inflation looks like, folks. So for the last 20 years, when you have 2% inflation each year, this is what it looks like. Nearly 50% devaluation of your savings. This is what inflation does. Tax will decimate many portfolios, and this is where Peter Schiff is talking about. People will have assets, the stock market, for example, and people will think, oh, look, it's now 40,000. So the Dow's at 30,000. So Peter Schiff says it might be 40,000 next year, or the year after, or the year after that. But on an inflation adjusted basis, it's gone down because of inflation. Assets like gold and Bitcoin and silver and the like will have gone up so much because of the devaluation of the dollar that 30,000 to 40,000 increase in nominal terms with the Dow is really a loss. And this is what Peter Schiff is talking about. So looking at gold, so gold has fallen recently from its peak. Why is that? So one of the big things I keep talking about is the tailwind for gold is real interest rates. So at the moment we've got negative real interest rates, and that is a tailwind for gold. And we'll have a look at that in a second. But what's happened in recent times, we've had people shorting the 10-year Treasury. So the Treasury bonds have just been in the biggest bubble. I talk about this all the time, that bonds are in the biggest bubble at the moment. And so we've had a lot of people out there shorting the bond market, the 10-year Treasury market. And so when you short that, when the bond prices come down, what happens is yields go up. So we've seen that the yields on the 10-year has been moving up, and you can see that in the blue line. So in recent times, the blue line has gone up, and so that's changed that real rate, that inflation-adjusted 10-year Treasury rate around. And you can see gold in the red there has come down. So the further real rates go negative, that is bullish for gold. So as real rates move away, so they're still negative, but they're just not as negative, then that's bearish for gold. And this is one of the big things that I look at as to whether I buy gold, sell gold, accumulate more gold, stop buying gold, but continue to hold the gold that I've got. This is one of the big things that I look at. So moving forward, I still think that, as I said, central banks have backed themselves into a corner, governments have backed themselves into a corner, and they're going to continue to deficit spend to create new currency units and so forth. So I still think even yield controls coming in. Some people, even the Keynesians, think that, and they're calling for central banks and the Fed themselves to go negative in real terms. There's calls here in Australia for the RBA to go negative in real terms. And so that negative real rate, and as the economy's open back up and demand comes back, and there's a Jim Rogers call. Jim Rogers reckons CPI is going to just run rampant over the next couple of years when demand comes back. So we've created all this new currency, all these new currency units, but at the moment we don't have the demand back because the world has been in lockdown or going into lockdown or coming out of lockdown or whatever. And so, when that demand comes back, and when those currency units start chasing really less goods and services, because we're going to have less businesses, Okay, so as businesses go under, default, go bankrupt, then there's going to be less production, goods and services, but there's a whole heap more currency units chasing those goods and services. That hasn't happened yet. That hasn't happened yet. So even though gold is in an adjustment phase, look, I do see gold maybe coming off from a technical point of view, maybe coming off another couple of $100 an ounce from here. Silver, I could see that falling below $20 US again, maybe down to $18 or $19. If that is the case, then guess what? Guess what I'll be doing? Yeah, you can work it out. So here, this is just an inflation adjusted, the 10-year Treasury rate, and you can see the gold price year on year. So when real rates go negative, which you can see back in the 70s, you can see that the gold price skyrocketed. But then when real rates were positive, well, that was negative for gold. Okay, so it's pretty straightforward. What's interesting, 21% of all US dollars were printed in 2020. So this is what I'm talking about. New currency units. This is huge. This is huge. When this starts getting out there, and we can look at velocity, which is low. Now, I don't take a whole heap of notice of velocity, but when it really does start getting out there chasing less goods and services, all these currency units, I mean, think of it, okay? So you create more currency, all right? Let's say you had one banana, and there was a lot of people that wanted that banana. Now, that banana is likely to go up in price, all right? Now, what if you had millions and millions and millions of bananas? So let's say you had one banana and you had 10 people that wanted it. That's now a pretty valuable commodity, right? Let's say those 10 people, now there's millions and millions of bananas, and you've got 10 people that just want one banana. What's going to happen to the price of bananas? Well, the same thing with currency. You print a whole heap of currency, you create a whole heap of currency. Guess what happens? It loses value. Here we can see the global debt as we're pushing 300 trillion. We'll get there. We'll hit 300 trillion. And there's a whole talk about the Great Reset proposal, and I can tell you there's nothing good about what the folks at the World Economic Forum are pushing with the Great Reset. All that they're doing is stealing your savings and real wages. Everything they're calling for is just another tool for cronyism. And, I've preached forever that we do not have free market capitalism. We have cronyism. We have, whatever you want to call it, corporatism. And Joseph Schumpeter, the great economist, talked about, the importance of creative destruction, and that cronyism will ultimately be, or corporatism will be, the end of capitalism. And, maybe we're there. I don't know. I still fight for free market capitalism because, well, it is the best. It pulls people out of poverty. It gives people freedom. It's extended people's lives. I'll do a video on socialism. We'll have a look at that in a future video. And I just think socialism, communism, whatever, they're both a form of Marxism, is pure evil. Pure evil. There you go. Boom. You can hate me. I think it's pure evil. But, this cronyism, once again, it just steals from savers, destroys real wages through the devaluation of currency, and just benefits continued government intervention. Now, what gets pushed out there a lot lately, especially here in Australia, is repayments. So people say, well, you know what? Repayments, it's now just as cheap to buy a house because the repayments are the same as rent. Okay, repayments are the same as rent. Yeah, that's with basically 0% interest rates. That's, banks are now offering here in Australia 1.8, 1.9% mortgages. So, of course, when interest rates are that low, it reduces the repayments. And so it looks affordable. the problem is, we're talking about a 30-year loan here, so you better hope that interest rates stay at 1.8%, 1.9% for the next 30 years. You really think that's going to happen? At some point, inflation is going to, CPI increases are going to get out of control, and interest rates are going to have to change. And this is where it's going to cause huge, huge damage to household and businesses' balance sheets. So, yep, right now, affordability, no worries, mate. She'll be right. People need to look to tomorrow and beyond. Riding the wave in the US, there's been huge amounts of refinancing. Same thing in Australia. In our business, we've seen the same thing. Huge amounts of refinancing throughout the surface sickness this year. We've had people drawing on their offset accounts and their lines of credit, freeing up cash, trying to make sure that they're in a position to get through the difficult time. So in America, you can see that the volume of cash out, second mortgages, HELOC, which is just a line of credit, home equity line of credit that we call them in Australia, just a line of credit, is the highest since pre-GFC, 2007. And the same thing here in Australia. So this taking equity out, refinancing, trying to lower mortgage rates, freeing up that cash to improve household finances has been a big push, and we're seeing that. So there's a lot of liquidity out there. So a lot of people are putting that into assets, along with borrowing at low rates and all the liquidity from the central banks. So it is no wonder, it is not surprising that we are seeing asset prices jump up so much. But the real problem, or the real thing is going to be, is if we get, and we will, the CPI increases, that real inflation in the economy, what will central banks do? What will governments do? Will they continue to run massive record level deficits, wartime deficits? Central banks continue to create new currency units, or will they allow interest rates to rise? Will they allow that to happen? And then obviously that's going to have a big effect on asset prices in nominal terms. So this is going to play out one way or another in the next year or two ahead. And it's going to be very dangerous, and some people are going to be absolutely creamed, absolutely wiped out. When you look at the expectations, so this is Morgan Stanley, when you look at the expectations of quantitative easing, so this is central bank intervention and currency unit creation moving into 2021, you can see that the expected average monthly quantitative easing is in the billions and billions of dollars, and all the major central banks, you can see the Fed and the ECB, they're leading the way, and Bank of Japan, Bank of England, but look at the RBA for those of us in Australia. The RBA is right up there now. After the GFC, our central bank didn't do what other central banks did, but we are now all in on that. And New Zealand, as a percentage of the balance sheet, so Australia and New Zealand get the gold medal there. As a percentage of our balance sheet, central banks down under are doing a lot more than others. The Fed balance sheet keeps growing and there is no exit. This is what I'm talking about. Peter Schiff and others are saying that they've now backed themselves into a corner where we just keep printing and printing and printing until this thing just explodes one way or another through a real crash in real terms or in nominal terms. So yeah, let's see if he's right. Looking at where we are in an overvalued position, and this is an old chart, so this only goes back to 2014. This goes back to 2014, and the S&P is a lot higher now. yet we've still got that trend, that regression back to that trend line. We've got a long way to fall on a nominal or on a nominal basis. So be very, very interesting to see what happens here. So moving forward next year, Bank of America will ask, what asset classes do you think will outperform in 2021? They're saying emerging markets. I think that might be right. I've said previously I'm very bullish longer term on countries like India and Indonesia. They've just got wonderful demographics and urbanization. So there's massive amounts of opportunities, I believe, and I have got some exposure in the Indian market, in the Indian economy. And look, it's got some challenges right now, but long term, I think there's huge opportunities in those two markets. They're the two that I'm very focused on studying and obviously investing in. S&P 500, oil, gold, US housing, Bitcoin, US Treasury. So you can see there, according to Bank of America Global Fund Manager Survey. So anyway, what do you guys think? Do you think we're going to have a crash in real inflation adjusted terms of the stock market? Are we going to get a stock market crash in nominal terms? Or is there not going to be a crash at all? And the stock markets are just going to continue to rise with no inflation, no devaluation of the currency. What do you guys think? And what are you guys investing in? Love to see your comments below. Don't forget to like, subscribe, and share the channel. If you enjoy the content that we make here, please let your friends and family know so that they can get this content and get this education so that we all can learn together and make good decisions regarding our investments and our capital. So thanks for joining me. I'll see you again on another episode of Finance Uncut.